Hello, friends, and welcome back to Market Shares. I'm your host, Tony Blodgett, and bear with me today. I've got a little bit of a cold. Just got done with a birthday party at Dave & Buster's, and I don't know if you've been to a Dave & Buster's. It's like a big arcade, and I'm pretty sure it's like the ultimate germ factory, so I'm pretty sure that's where that came from. But today, I want to get into two topics that have been in the news a lot. And if you're in the mortgage and real estate industry, my guess is that your social media feed has been filled with posts and memes about these two topics. Well, the first one in particular, which is the now infamous 50-year mortgage tweet that we all saw from President Trump. And I mean, man, just that news alone brought on like an onslaught of people, you know, posting about a 50-year mortgage and what are the pros and cons, and some people are totally for it and some are totally against it. And I saw a number of great posts where people were showing like side-by-side comparisons of a 30-year versus a 50-year and, you know, all of that jazz. And look, I think that's great. I think it was helpful information to kind of start wrapping our head around that. But, you know, I made a few comments in social media about this, and my take, I think, is maybe a little different than some. I mean, I've been in the mortgage business for 28 years, and so I've seen the gamut of different, you know, options that have been rolled out throughout the years. And in my opinion, when someone talks about a 50-year mortgage, to me, this is just kind of a, you know, I guess a medium point between a 30-year amortization and an interest-only loan. And look, I'm a big fan of interest-only loans in the right circumstance. You know, we talk about purchasing real estate and, you know, why people use it as an investment vehicle. And the reason is primarily leverage, right? You can put a small down payment to control a large asset. And if that asset appreciates in value, you know, your return is really based on your initial investment, not on the total value of the property. And so that is, my friends, leverage, right? And so when we think about leverage, we also think about, well, if I want to put as little down as possible to control the largest asset as possible, wouldn't it also make sense that I'd want to put as small of a monthly payment towards the maintenance of owning that asset, right? Now, some people argue, yeah, but you're not paying down your principal balance, and that's true. And I think that there's obviously some, you know, wealth or equity that is built over time by reduction of your principal. But let's be honest, I mean, during the first 5 years of any mortgage amortization schedule, you're not really making much of a dent into your principal reduction. I mean, these things are so front loaded with interest, and most people aren't keeping their mortgages for much longer than that. Now, we know that, you know, recently with low interest rates, people are keeping their mortgages for a little bit longer. But look, I think that's kind of beside the point. But there's some other thoughts that I have about this 50-year mortgage, mainly, which is there's just no way that this is probably ever going to happen, right? At least not in the way that people think that it is. Now, I did not see one. I'm not saying it didn't happen, but I did not see one of these posts on social media where they were showing the comparison between a 30-year and a 50-year mortgage where they were running it at a higher interest rate. Everyone was talking about, you know, look, if you got a 50-year loan, it really isn't that much savings over a 30-year, which I totally agree with. But it's worse than that, because if there really was a 50-year mortgage, like let's talk through what it would take for that to happen. I mean, we have a well-established 30-year treasury bond, you know, the 10-year treasury bonds. We have 30-year, you know, bonds that are well-established, 30-year mortgage-backed securities, and there's a stable market for these. And part of that stability is understanding, you know, the prepayment speeds of those and the likelihood of default and all of these things, right? There's a lot of factors that go into why the 30-year is the right amount of time, and it's been well established. So if you think about a 50-year, you would have to create essentially a new market for a 50-year bond, which doesn't exist. And it's just reasonable to me to assume that it would require a higher yield for investors for a 50-year note. So I just don't see any world in which the interest rate for a 50-year mortgage would be close to the current interest rate for a 30-year. I mean, we don't really see that with a 15 and a 30-year. 15-year rates are lower. Now, we can talk about inverted yield curves and all this stuff, but in a normal yield curve, simply by definition, shorter term interest rates should be at a lower yield, and higher, longer term are at a higher interest rate, a higher yield. So I just think that to compare these as if they had the same interest rate is the first misnomer. The second thing is, we would have to create a whole new market that doesn't exist today, and the demand for that market, right? Like, who's going to be buying these 50-year mortgages? Who's the investors that are going to buy these? It's hard enough to get people to purchase 30-year mortgage-backed securities when they can buy treasury bonds that have, lower yields, but seem to be a safer risk, right? So now we're going to compete against 30 years in the open market with a 50-year that's unproven. I just don't think that it's likely. And if it did, it would be at a higher interest rate. And I did some math. I'm not going to pull up like a side-by-side comparison of the difference. You guys have seen, hundreds of those if you're in the mortgage and real estate industry. But the comparison I did was, how much higher would the interest rate need to be for there to be no difference in the payment whatsoever? And it's about 100 basis points. It's about 1 point in rate. So a 6% payment on a 30-year, a $500,000 loan at 6% interest on a 30-year loan is $2,997, call it $3,000. And it's 7% on a 50-year note, it's at $3,008. So, I mean, eventually we're within, $10, $11 here difference. So a 1% premium in the rate in order to be a 50-year completely negates any monthly savings whatsoever. And I think that that's a reasonable number. Matter of fact, I think in the early stages of this being an unproven market, to think that premium wouldn't need to be 100, 150 basis points higher to support a 50-year mortgage, I think is totally reasonable. So, to me, it's just a silly thing to even talk about. Now, what I have seen is I've seen 40-year amortizations. And if you think about the 40-year loans that are out there, and most of you that have been in the mortgage industry know this is a feature of a 30-year mortgage, right? So it's a 40-year amortization on a 30-year note. So it's a 40 due in 30. And it's really like an adjustment. There's like an LLPA for that feature, if you will, to be amortized over 40 years. So if we were going to do this at all, to me, that would be the more plausible way in which this would be done, which would be like a feature of a 30-year loan. So you're still using the well-established 30-year MBS as kind of the baseline, and then you're adjusting for the 50-year amortization. But again, that adjustment, like all loan level price adjustments, we've talked about them a lot here on this podcast, would come at a bit of a premium. Now, maybe in that case, we're talking more like 50 basis points in fee versus rate. So maybe now we're closer, but still eroding that already small amount of difference in monthly payments. So look, this 50-year thing, I've had a lot of people reach out to me with what my thoughts are on it. Those are my thoughts on it. I don't see it really gaining much traction at all. And if it does gain any traction, then it's my guess you would see it as a feature still based on the 30-year 30-year MBS that we're all very familiar with, that investors are familiar with. And that's probably how that would come to light. So also on X, we see another post about the idea of portable mortgages, right? Now, if you're in the mortgage business like I am, and you saw portable mortgages, you're like, oh my God, that would immediately like you wouldn't need loan officers anymore. You could just take your mortgage and take it with you to your next property. So let's talk about that option for a minute, because I also think that this is highly unlikely. I'm going to talk to you about the reasons why I think that. And then I'm going to give you a couple positives that I think have come out of this whole conversation. And that's what I think we need to hold on to for now. But let's talk about these portability issues. Now, this is not a new thing, right? There are portable mortgages that exist. Matter of fact, in the United States, we see these sometimes on commercial type debt. And you see this as well in Canada has some portable mortgages. The United Kingdom, some other countries have this. Now, one of the big differences is they're typically not 30-year amortization, right? Like you can't get a 30-year fixed mortgage in most places in the world. Like up in Canada, as an example, I think the longest term that you can get is a 5-year adjustable rate. And same thing with commercial loans. So we're talking kind of more in this structure that would typically be reserved for a commercial type of a loan. And the big challenge with that is it takes the risk away from the investor and it puts it back on the note holder, right? It puts it back on the person purchasing the property to now be subjected to, the gyrations that may happen with interest rates over time. So one of the benefits of a 30-year fixed rate mortgage is that once you lock that in, you've now pushed that risk to the investor side. And obviously that's priced in based on the timing of what the market's doing at the time that you lock in that rate. But it is a fundamental difference in the shifting of risk back to the customer, to the consumer, to that note holder if you go to this loan that may be portable, but it's adjustable on a regular basis with the moves in the market. So this is not a totally revolutionary thing, but here's why I really don't think, besides the, is it a good idea thing, there's some other reasons why this probably wouldn't work in the United States. And first of all, the market that we have for mortgage-backed securities is very stable, but it's also very dependent on individual loans being secured by individual houses, right? So an investor knows that the collateral in which they're investing in is a home. There's a physical property there that has a specific lien against it, whereby if that borrower does not pay their monthly payment and the investor loses out on that, there is repercussion for that. And so all of the paperwork, all of the disclosures, everything that is done in the mortgage business is about underwriting a package that is not just based on the borrower's creditworthiness, but it's also based on the collateral in which you are leaning. And then all of the paperwork, ties that all together. So when you bring in the idea of keeping that note and then making it portable to multiple different properties over time, there's just no infrastructure to be able to support that in our MBS market as it exists today. So, and none of the documents that are, built into, this pooling, the servicing, the list goes on of all the different, language that would have needed to be put into not just the original note and the deed of trust and all the security instruments when you close the loan, but also all the agreements between the banks and the investors that are buying, these more and investing in these mortgage-backed securities. So I don't see how you could possibly change all of the existing loans that are out there and all of a sudden make them portable, right? So perhaps we could talk about new loans that have a portability feature, but we'll talk about that in a second. Okay, so I got some notes here. Not only that, you guys, mortgages, when you think about the servicing value of a mortgage, right? So you got the value of the note itself, like what's Fannie Mae willing to pay for this 30-year fixed rate note, and then you got the servicing value. Well, think about the servicing value is based on an assumption of prepayment, right? Either through refinancing or through turnover, right? That person buying a new home. This would completely blow up every prepayment model that exists out there, because there would be, assuming it was a really good interest rate, there would be no need for prepayment. meaning no need to refinance that loan, or you wouldn't be selling it when you purchase the new home. You just move it with you. So this uncertainty about servicing would more than likely widen, premiums on MBS and probably drive up the interest rates a little bit, would be my guess. And then think about this for a second. So mortgage companies wouldn't, you would still need to originate new loans, but most of the transactions we're doing, like we know right now that I talked about this in the last podcast, 20% of purchases are first-time home buyers. That assumes that all the rest of the mortgages are not first-time home buyers, meaning they probably own a home right now, a good portion of them. So you would decimate the mortgage origination, companies, because you really wouldn't need that. But then who's going to do all this paperwork? Because there's still a ton of work to be done on these, and it would have to be the servicers, right? So the servicers would now have to become the people that are, you still have to do a new appraisal. You got to get mortgage insurance for the new loan. You got to get new homeowners insurance, maybe flood insurance policies. Like, is it a condo? Is it a PUD? Like, I mean, you guys, there would still be an origination process to slide in this new piece of collateral. And who's going to do all that work? Do all of a sudden the servicers become like the pseudo originators of these portable mortgages, or I don't know, a lot of unanswered questions on how that would even work. And like I said, my notes here, new mortgage insurance, you got to treat this like a loan modification now. Is it just a loan mod where you're swapping out the property versus a whole new loan? What about TRID? Like, what about how does that fit in, to the equation? And then, just the pooling of loans and the tracking of those loans, and then finding where that loan's at, once it's sold into the secondary market, to be able to kind of pull that out, replace the property, put it back in service. I just don't see how all of that would play out. And not only that, let's just say that we worked all that out. Like, who benefits from this, right? Who benefits from this portable mortgage idea? Well, it's really only the people that currently have loans that they originated during COVID that are at 2.75 to 3.25% interest rate, right? I mean, that's really why we're talking about this, right? We're trying to solve an affordability issue that was caused by a period of below market interest rates and the lock-in effect that was the result of that. And this really seems like a short-sighted solution to a temporary issue that is the lock-in effect that we're experiencing right now. And I don't see how this possibly addresses that particular issue, because as I mentioned, those loans are already written. And I don't see how you go back and amend all the agreements on the origination and the secondary market that's already embedded within those, those mortgages, those liens, those security instruments. Like, I don't see how you make those changes. So it just seems like it's a fun thing to talk about, right? I mean, I've really enjoyed seeing all the social media posts and whatnot, but I just don't think that it's probable. So not only does it not benefit, certainly doesn't benefit first-time home buyers, only benefits a small segment of people who do have those really low interest rates, but it also is skewed towards people who have enough equity in their property to actually be able to get some equity to put down on the next property, right? Because if you're just keeping your note, you don't get to necessarily increase the size of that note, right? Or do you? Like, so many questions. I just don't think it's a really reasonable solution. So what is likely? Like, what could happen here? We talked about what could happen with a 50-year. I think it's more of an option or a feature of a 30-year. If we saw anything, it would be more likely that. Well, if we saw anything around this portability thing, what would it probably look like? Well, here's two things that I think it could look like. One, I wouldn't be surprised if Fannie and Freddie or FHFA, since I think it was Bill Pulte who sent out this text, that we're really looking at portability of mortgages. Yeah, and I believe that they are. I believe that they're looking at that. And I believe the more they look at it, they're going to find all the things that I just mentioned as making it next to impossible to do anything, especially with existing mortgages. So what might they do? Well, they might roll out like a pilot type of a program, right? Like a small scale, really confined product that's, specific on, what kind of loans could be in there, 30-year fixed rate, owner occupied, certain DTIs, certain LTVs, that we could have this portability feature. And it would be on a small segment of loans. It would probably be, defined on the window of time in which that loan was portable. It would probably be defined on how many times that loan could be ported or moved, and probably limited to like one time or something. So it'd be kind of like a pilot program, like a niche type of a situation that Fannie and Freddie roll out to try it out. Now, look, maybe that's the introduction of something that could be scalable in the future. That's possible, but I think I wouldn't say it's likely. I would say that if they did anything, it would be to roll out probably a pilot type program, something, and who knows if there would be any interest or not. I mean, Fannie and Freddie roll things out all the time that no one does anything with. So just because they roll it out, just because they check the box that they're trying to do something to address the affordability issue in the United States, doesn't mean that it gets a lot of attraction. Here is the other and more likely scenario, is that we see some expansion on agency loans, Fannie, Freddie, conforming loans around the idea of assumability. As you guys probably know, FHA and VA loans are assumable by nature. And so maybe what you see is a broadening to where you see more assumable options with the agency loans. That seems like something that they probably should do anyways. But let's be honest, like the assumable loans that even that exist today, like this is not a massively utilized concept. Now, look, it's been talked about a good amount recently because there are so many loans at very, very low interest rates originated during COVID. And so this idea of assuming those loans, look, I'm not saying it's not a thing. It's just not a huge percentage as you would think, because there's lots of challenges with it. I mean, typically we're talking about FHA and VA loans, right? So a lot of first-time home buyers, these are typically entry-level homes. So now you have a new first-time home buyer that wants to assume that loan. But if you bought it during COVID, you got a ton of equity in that property. And the challenge with the assumable loan is there's no way to bridge the gap on that equity. So you can assume the underlying loan, but they're not selling it for that price, right? They might owe $250,000 on the house. It's now worth $500,000. Where's the other $250,000 coming from? And most first-time home buyers don't have the ability to bridge that gap. So then what do you get, a second mortgage at a higher interest rate? Taking on a loan that's an FHA loan that has mortgage insurance for life that you can't get rid of when there's equity? I mean, seriously. Like, these aren't very popular as they exist today. Maybe a little bit more on VA, but again, same challenges with bridging the equity gap, You just don't see it a lot. I'm not saying it doesn't happen. It does. Most servicers have had to dust off the rule books on how to even do assumable loans. And we've seen more of them than we've probably seen in, 30 years. But it's still not a huge percentage of it. So I think that from this portability conversation, maybe you see some expansion of options around assumable loans with Fannie and Freddie. But look, guys, I don't mean to be the doomsdayer here. I'm just happy. This is the good news. The good news is we have, the FHFA, Bill Pulte. We have, the president. We have people looking at the housing industry and acknowledging that we have some serious affordability issues, and maybe there's some things we can do to address it. That's the good news. Now, these first two ideas, I don't think they're great. That's just me. I don't think they're great. But maybe this starts a think tank, right? Maybe this starts the idea of, okay, well, no, those weren't great ideas, but let's keep throwing them out. Let's spitball here, guys. Let's see what we can come up with that maybe would turn up a really good option that's going to help with affordability. I'm going to go back to, you could start by dropping some of the LLPAs that you charge, and that might help. A few other things that, recently came out. They removed the minimum credit score on conventional loans. No minimum credit score. Okay, everyone's like, oh my gosh, we're back to the days of subprime again. Like, this is horrible. I mean, just the meltdown on social media about this stuff is hilarious. Like, as if they don't realize that you still have to get an AUS approval, right? I mean, just because there's no minimum FICO score doesn't mean that they've completely changed their risk tolerance and underwriting guidelines. It just means that the score itself isn't necessary. Now, from what I'm seeing, if you want mortgage insurance, though, the credit score is pretty relevant still. So you still need to get mortgage insurance. So if you got a low down payment and no FICO score, and somehow you still make it through the AUS and you get an approval, you better hope you got 20% down, because mortgage insurance is still going to be difficult to get. But look, this whole no FICO score thing is, to me, this is not a thing to really freak out about. I think there's people out there that are, low, they have low credit utilization, and therefore they don't generate a credit score. And those people, some of them should be able to purchase a home if the rest of their risk profile fits, what Fannie and Freddie are looking for. So to me, this is a good thing. It's going to help people that don't use credit in a traditional way to be able to possibly get a mortgage. But don't kid yourself. Just because they said they removed the minimum FICO does not mean that they've significantly lowered their standards for how they evaluate risk. And my guess is most people that have a low FICO score, that would be under what the previous minimum was, and it's due to delinquencies and not paying their bills on time, you guys, they're not going to get approved, okay? They're going to get a refer, and the loan's not going to work. So anyways, people get really, really hung up on that. And before I wrap this up, I'm not sure if I was clear on my opinion about the 50-year mortgage. So I've had people ask me this specifically, so I want to make sure I address it. The way I think about a 50-year mortgage, as I said, is like it's like a gap between a 30-year and an interest-only loan. And for that matter, a 15-year, right, is even better. I think that as mortgage advisors and as people who are helping people understand the options that they have when they're looking to secure real estate with a mortgage, whether that be their primary residence or if they're an investor, right, we're going to treat those kind of people differently. They have different goals. I think it's a tool. It's a club in the bag, if you will, that could be used. I'm not opposed to the idea of a 50-year mortgage, just like I'm not opposed to the idea of an interest-only loan. For some people, it's the right solution. For a lot of first-time home buyers, it might not be the solution, and it's certainly not going to significantly increase their buying power, in my opinion, because the payment's not that much cheaper, and when you add on the fact it's going to be at a higher rate, it doesn't work. But if they want to roll out a 50-year mortgage option, and it's something that we have to choose from when we're looking at the right solutions, given a particular borrower's goals and strategies around, owning and or investing in real estate, I'm not opposed to it. Like, I don't have a problem with it on the face of it. I think more options are better. But I do think it's incumbent on the mortgage professional to understand the pros and the cons, right? What I loved about those people who pulled up Mortgage Coach and did like a side-by-side analysis, these are people who understand that whether it's the right option or not, it's our responsibility to share with the borrower the implications of the decisions that they make. And we need to show them their cost of credit over time, and we need to have tools that help us to do that so that we can advise people on understanding exactly what it is that they're getting into with the decisions that they make. So that's my take on the 50-year mortgage. It's never going to happen, in my opinion. But conceptually, I'm not super negative on the idea. And if someone's goal if someone's got a fixed amount of income and they want to retire and they want to get their mortgage paid off, then do a 15-year mortgage. Like, what are we doing? Like, get this thing paid off, be debt free. If someone's looking to acquire multiple properties and they have the cash flow to manage that, and they're building a real estate investment portfolio, and they want to invest in other properties and really maximize the leverage available to them, interest-only loans make sense in cases like that where people understand what it is they're getting into and how they work. So it's not the same for everybody, guys. That's part of why we have mortgage advisors to begin with. So that's my hot take on 50-year mortgages, portable mortgages, and we'll see how this evolves. I'm hoping that they keep throwing out these ideas on how do we help affordability in the United States. And as they do, we'll talk about them. And I'm hoping that we come up with some really good ideas because I'd love to see more than 20% of all homes being purchased be by first-time home buyers. We have a whole generation that is not building the kind of wealth that we've seen in generations past. And that, in my opinion, is a sad thing. And I'd like to see it change. So if you guys enjoy this episode, share it with somebody, right? Just let someone know about market shares. Also, subscribe. Like I told you, we're trying to get that number of subscribers up. There's lots of reasons why we need to do that to help this channel and our message grow. So if you like the content, but you're not a subscriber, consider subscribing today. And make sure you tune in. Every Friday, 10 a.m., we drop a new episode right here on Market Shares. And I'll see you then. Take care.